Depreciation and amortization. So it's helpful to start backwards with a little bit of a foundation there in talking about operating expenses versus capital expenses. Operating expenses are those expenses that they hit the P&L or the income statement as they happen. Sales and marketing expenses, overhead, general and administrative expenses, R&D, etc. Those are expensed as they happen and they hit the P&L right then. Capital expenses are different. With capital expenses, a company's putting money into assets, things that they're going to utilize for a while. And in the accounting world, one of the fundamental principles in the accounting world is called the matching principle. The accountants want to match the expense of something with the benefit derived from that. So when we purchase an asset that we're going to utilize for a while, the accountants therefore want to capitalize that. They want to spread the expense out over the period of time that the company will be using that asset. Now, in the United States, there is what's called the Financial Accounting Standards Board, or FASB. FASB is the independent private board that the government set aside, and they set the standard for what a useful life is for all assets. So if it happens to be a computer, for example, that might be 3 to 5 years. They're in a range, 3 to 5 years. If it's a vehicle, a delivery truck perhaps, then that might be perhaps 7 to 9 years. If it's a piece of real estate, an office building, that might be 30 or 40 years. And so under this matching principle, the accountants say, look, we invest in this asset, we're going to get benefit from it for a certain amount of time, this useful life, and so we want to spread or capitalize those expenses out over that useful life, matching the cost with the benefit. Another term that we use for that is depreciation. So when a company buys an asset, let's say in year 0, they buy a piece of equipment, and the Financial Accounting Standards Board, or FASB, says, okay, we estimate a useful life of 10 years for that piece of equipment on average. In year 0, when that piece of equipment is purchased, nothing hits the P&L at first, but the full cost of that asset goes on the balance sheet as the cost of that asset. And so we say, okay, that's on our books, that asset is valued at what we paid for it, and now we are going to depreciate or reduce the value of that over time. Just another way of saying we're capitalizing or spreading that expense out over time. Depreciation is the term we use for tangible assets, things that we can touch, equipment, computers, vehicles, etc. Now there's another term that we use, which is amortization. Amortization means exactly the same thing. It's capitalizing or spreading those expenses out, except it's for intangible things. Examples of that might be things like software or patents, copyrights, sometimes intellectual property, etc. These intangibles that have value, we invest in them, we pay for them, and it's just traditionally the term for spreading out those costs for tangible assets is depreciation, and the term used for those intangible assets is amortization. And what are the advantages, or why is it important to understand this? What are the advantages to a company when it comes to depreciation and amortization? Well, first of all, if a company were to expense the total cost of that asset up front, it would make their profitability very lumpy. If that, even though they can use that asset for many years, the full expense would really reduce profits significantly in year 0, and then not show any costs going against that, and kind of artificially increase profit in the subsequent years. There are also some tax benefits that companies can use, take advantage of as they capitalize or depreciate those assets. By reducing those expenses, their profit over time, there are some benefits from a tax purpose as well. So those are some of the key reasons why companies like their ability to depreciate their assets over time. Okay, so to sum it up, companies, when they invest in capital assets, they're allowed to spread that cost or capitalize those expenses over time, helping to tie the cost of that asset evenly to the benefit derived over the years. And there are some tax advantages and some benefits in doing so, and it also helps to bring a smoother sort of real picture on profitability and how that asset is contributing to both driving revenue and creating profitability. And that's the difference between depreciation and amortization.